Good evening, everyone, and welcome to Rivero Capital Annual Meeting 2026. It's great to see so many of you joining us today. My name is Larissa, and I'll be your host for today's meeting. In just a moment, I will hand over to Daniel, who will first proceed to the formal voting procedure and then do a short presentation and recap of 2025. After Daniel's presentation, we will move straight to the Q&A session. So with that, let's get started. Please, Daniel.
Thank you, Larissa. So for those of you just joining now, the formal vote was completed. All yeses, no nos. Big surprise as usual. All right, so 2025. Not happy with the result, obviously. Some years will be like that. Still considering everything and excluding the currency headwind we had, it was an unacceptable year. There are simply going to be years where there are a lot more things for us to have and years where there is less, and this was one of the latter. I am happy with the changes we made in March. I explained a little bit about the background for that in my annual letter. The reason why we started with a larger percentage salary allocation in the early years was simply because we started with 4.4 million. And it was really the only way we could start, because at that point I had asked absolutely everyone I knew and then some. And all things considered, I'm pretty happy that we started when we did, because in life you can wait for a fairy to come knock on your door or wait for the perfect time to start something, but that usually means things will not start. So I'm pretty happy that we started like we did, even though that came with some disadvantages, you might say. But with the changes, I think it now looks very promising for the future. So that's what I'm focused on. As for the currencies, we do have now a viable hedging solution at a very reasonable cost at around 40 basis points, 0.4%. This is something that will be discussed in our board, and it may be that we will implement it under certain conditions, and under other conditions we may not implement it. If we decide to go ahead with any combination of hedging or any hedging at all, it will be announced in a press release, so you'll see it. I won't be going in too much into our specific holdings. You can read about those in the letter. But there was a section where I said there's quite a few things to improve. And so specifically, what were those things? Maybe to start, why did we need to change anything at all? And I just think in life and in business in general, if you look at any successful companies, there have been quite a few changes along the way. If you can tell me one company which looks today, say 10, 15, 20 years later, the same that it looked on day one, I'll be quite surprised. And it usually doesn't happen like that. So specifically here, maybe I underestimated a little bit how much things have changed in the past few years. Basically, what I was doing 3 to 5 years ago is not enough anymore. Things are moving faster, and it needs to be. You need to adapt to it, and so you might think, well, it's not great that you underestimate things, and that's true. But unfortunately, that happens in life, and I've had a few occasions like that before, actually. I can at least recall a few when I thought back, and I'll just briefly tell you about one of them. And it was the Nordic Junior Championships in badminton, actually. me and my doubles partner were quite one of the main favorites to win or do well before the tournament. But then in the team tournament, we ended up losing to a Finnish pair, and Finland is not a big badminton nation, and it was clearly a case where we underestimated the opponents. We went in a little bit too relaxed, but the wake-up call that led to allowed us to move on and win the whole tournament. And there have been a few occasions like that for me in my life. I think this was one of them. As I said, I think the year was fine, but it was still a wake-up call that if you're not focused and to the maximum and are quite ruthless about what I accept and what I don't accept, things can happen. And now we had the unfortunate circumstance that so year coincided with 9% negative currency headwind. So it served as a really good wake-up call, and I think it will be good for us going forward. If I were to, in one sentence, tell you what I have most changed, it's being focused and tightening up the ship a little bit. So to some extent, that means being a little bit more ruthless, not accepting performance from some companies that have been subpar, and also accepting what goes into our portfolio and what remains, constantly looking at that. There's also an emphasis on easy to understand companies, really keeping things very simple. And I'd also mention some more focus on margins. It's something that I used to have been more focused on in the past, which maybe I didn't do as much in the past few years. And what do I mean by that? It's if you have declining margins in a company over a year or two, it's very difficult to increase earnings with that. Even if top line increases a lot, it's very difficult unless margins are also stable or preferably expanding even a little bit. It just simplifies things. So you want businesses where this happens naturally. Typically think subscription businesses, software businesses have been a good example of that in the past, and so on and so forth. But basically where you have a stable margin profile. And all in all, it's many small things that add up, makes us much better prepared to handle the bad news that will come along during the year. We also have opportunities that come along during the year, and it just makes it so much easier to take advantage of them with this more tightened ships, so to speak. And I do expect some more adjustments to our portfolio in the coming months along these lines. We've already had a few, which I wrote about in the letter, such as selling a few things and also investing anew in flatexDEGIRO, similar business to Avanza to some extent, and Theon, which is in the defense industry and based in Greece. You can read about those in the letter. And why do I think 25 was an acceptable year considering the headline numbers? And the answer is one of our main priorities will always be to be able to play tomorrow. If we are able to play tomorrow over time, we should do well. And in a year where almost nothing works, if you're only down single digits and even low single digits, that's equally important to making a whole lot when everything works. And in my book, maybe even more important. And investing is quite funny. It's a quite funny discipline in the sense that you do get advice from a lot of people who don't do it professionally if you have one poor year. And in this case, it was really one poor second half. And I had the same in 22. In that case, it was friendly advice, but very serious advice to invest in real estate. Because early in 22, the real estate companies in Sweden held up quite nicely while everything else was crashing. And with the rising rates, that sounded like a not the best idea maybe. And within a few months, real estate stocks had crashed, I don't know, 50 to 80% probably in Sweden. And my point here is not that it may well be the right thing to do to invest in what has recently been popular. I did get advice early this year to think about gold and silver, and also just the index. And of course, the reason why we're not going to invest in an index is because you can easily do that yourself. We're trying to do something different than the index here. But the point is, it may well be the right thing to do to invest in what has been popular, but it has to be done based on the fundamental merits of that investment and not because of the recent popularity. Because, yeah, this goes along with our focus on avoiding losses. Typically, the largest losses in investing is when you invest in popular companies under very favorable business conditions. So if those favorable business conditions change, say in a few months or a few years, which happened to real estate in 22, for example, that's typically when you can have the really big, large losses which do not recover. Because usually in good businesses, even though you have drawdowns, they will recover over time. So you do want to avoid the popular things under very favorable conditions. I think that's a key tenet we stick to. And it's, by the way, equally up and down that I'm never, or people that do what I do, we're never questioned when we do well, which is also, which is equally interesting, but it's human nature to sort of focus on the most recent past, which is fine. But it's, it's something that also serves as a signal. Like when you get a lot of advice from people who don't do it professionally, you may be close to a top or a bottom. I don't want to spend longer time on that, but just ask yourself how often professional athletes or some other discipline get advice from people who don't do it professionally, serious advice that maybe they should work on their stamina or their fitness or their jumping or technical aspects or whatever it might be. But investing, it seems to happen all the time. So it's something I've seen some of. But yeah, moving on to 26. It's been a very good start business-wise to the year. And the share prices of our holdings have been okay as well. We're up a bit for the year as of a few days ago, which I'm quite pleased with, given everything that's been going on. If you only look at large cap indices, you might not have noticed much, I guess, except for the beginning of the war in Iran, when those large indices moved as well. But otherwise, there's been a smaller bloodbath in Swedish small caps, some potential AI victims, namely software, but also a few others. And I would also mention some of last year's high flyers. I've had a particularly rough start to the year. And we've been avoiding those. I think Swedish small caps have recovered a lot, but are still a little bit down year to date. And one thing that you typically get every year, there are a few things like we have had recently with the Iran war, an AI scare. Last year, I think there was the April Liberation Day. yeah, there's something every year, and every year I seem to get the comment from at least a few shareholders and a few others as well that now surely this is a much more uncertain world than before, much more than normally. And the thing is that to me, the world is always an unpredictable place. I always say, okay, so tell me one time when the world has been a predictable place, and I'll agree with you. And usually people have a hard time doing that. And if you think back over just the past 10 years, which started with Brexit 10 years ago, surely at the time of Brexit, many thought it was the end of the world, or at least of the European Union, and what might this mean for the future, and so on. And then there we had Trump getting elected, then we had COVID, then we had inflation, and so on and so forth. And I think today we'd all be pretty happy just taking the Brexit as, you know, another day at the office. It feels like nothing today, but it's just something that's important to keep in mind when you're in the moment, because it will always feel like this is the worst we've ever seen. Yeah, just to end this short little intro, I think one quality that I try for River Oak to have is being impossible to kill. One way to be killed, of course, is to use much leverage, or one example, as I mentioned, you know, invest big in the popular companies, which currently have very favorable business conditions. That's also one way to lose a lot. And yeah, it's something I really try to do, and it's good. We do have. I'm able to take a lot more than what we have so far, and I hope we don't need it. But it's very good to have that buffer to know that, you know, you won't give up on it, and you make sure to create conditions where hopefully almost nothing can kill you as a company. And yeah, if you're disappointed with last year, I get it. I would just encourage you to also remember all previous years, and not to underestimate my incentives and my result here.
Now we will move to Q&A session. Daniel, in your shareholder letters, you often emphasize investing in business that would be attractive to own even if they were not publicly listed. I'm curious how you think about situations where a strong business is temporarily out of favor with the market. What signals help you distinguish between a genuine value opportunity and a value trap?
Yeah, great question. I think one really you know, central thing there is the underlying economics. I think one example of this is Meta, owner of WhatsApp and Instagram and Facebook. And in 2023 or 2022, really, as you may remember, that stock was really out of favor. And I think it was down something like 80% in the past years from a high valuation. But it was basically, there were quite a few question marks whether they would actually survive as a business. And two things there were key. Are people still using their products? And secondly, what are the economics? So that would be, you know, do they have the balance sheet to survive? In Meta's case, it was a very clear yes. But also, what does the cash flow look like? Because obviously, companies that go out of favor and have very limited cash flow, even though they may report high earnings, that can be potential problems. So you would generally try to stay away from those. It's not impossible to invest in those, because there might be reasons for cash flow coming in after, you know, in the first quarter or so on. But that's a very important thing. If people are still using the products just as much as before, or even more than before, and the underlying economics prove everything, then you really should ignore most of the things what is written in the media, and that's usually where you find the best opportunities. Now, the media is not always wrong. There is, of course, some cases where you should also consider things that are being reported. But yeah, I try to really focus on what is the company reporting, what is the CEO saying, what's happening under the hood, and not listen to. There will always be pundits and people with opinions that don't really did much more than read one or two articles or queried ChatGPT for an hour and then write an article about it. You do want to focus on the first-hand information and specifically those things I mentioned. I think one really big key is, are the people still using the products in a similar manner than before, or in some cases, the usage is going up while the media narrative is the complete opposite. One other example I can recall on this was Apple back in 2013 or something. It was so out of favor. Android was going to take over the world, and there were problems in China, if I recall it. And there were all kinds of problems. And it seemed like when one problem was out of the way, the next one came up in the media. And meanwhile, the shares were trading at 6 times earnings or thereabouts. And it was obviously a great time to invest. And there are always a few of those, and it's not easy to distinguish. So I'd say I'd also emphasize being, do it in companies that you're really familiar with. Don't do it in companies that are not really in your sweet spot, because it's very hard.
Thank you for the answer. Daniel, the world is changing fast. Do you, in the last few years, faster than before, does it influence your way of investing?
Yeah, it does actually. I think the main thing there is you certainly need to consider a lot more these days what will be influenced by the changes. And I think we've seen some of that already. Let's say 10 years ago, it was safer, so to speak, investing in software, because building that up usually took many years of development. We all know today that has completely changed. You can develop a great app or even a big platform today in a matter of days and weeks. There are some famous examples of that, where one which I mentioned, I'm sure many of you use cloud, and the code in cloud, they don't have any lines basically anymore of code that are more than a few months old. So that tells you one software that is used by hundreds of millions of people, many hours per day now, that code just renews itself all the time. So that certainly tells you something about how easy it is to build those things today compared to 10 years ago or 5 years ago or even 3 years ago. So that changes quite a bit how we think about those things. So you try to stay in lanes where there are certain network effects, there are certain unique assets, or things that are simply very difficult to copy, whether that's a big platform of a supply and demand side with a lot of users coming from both sides. That becomes a pretty powerful network effect. Obviously, many of the social media have similar network effects, because you're not going to go to a social network where none of your friends are. So it's probably one of the most powerful network effects we have. But so there needs to be some of those protectable things in the company, whether that's a network effect, whether that's something that's very difficult to replicate. And that certainly changed a lot over the past, just 5 years. Those qualities have always been important. Don't get me wrong, but since things change so fast, specifically in software these days, it's just a harder area to invest in, with the span of outcomes ranging from something that was maybe 1 to 10, and maybe now it's a 1 to 100 in terms of what could happen. So it would typically be something that I'm more careful with these days.
Thank you. Let's see if someone else has a question.
This is a nice summer day in Sweden, so it's understandable. People want to get on with things.
Let's see. Thank you for the answer. Yes, I guess that was the last question. So thank you again for joining us today in a sunny day. Thank you, Daniel.
Thanks, Larissa. Thanks, everybody.
Thank you, everybody.
Bye.
Bye.
Bye.